Hey there, Investorholics. Welcome to another ETF Spotlight review. Today we'll be looking at SPY, which is the State Street Spider S&P 500 ETF Trust. Brought to you by the people at State Street Global. So if you're looking for some international exposure, this ETF will give you exposure to the top 500 companies listed on the exchanges in the States. Always a good idea to have a little bit of diversification, so if you're chasing diversification, so it might be a good one to stick around and have a bit of a look at. Hey there, Investorholics, this is Scott. Crack the Sky Value Investing will be giving you up-to-date investing news and content so that you can navigate the markets wherever you are. My mission here at Crack the Sky is to give you the knowledge and the confidence to take control of your personal finances, expand your investment horizons, and crack your financial sky. So don't be afraid to give me a thumbs up and also subscribe. It helps get the message out there. It helps pump the algorithm for YouTube. Just in general, it sort of gives me a bit more motivation as well to keep doing these little reviews for you guys. Thanks. Okay, so let's just get stuck into it. So the investment objective of the fund. So SPDR S&P 500 ETF Trust seeks to provide investors results that before all the expenses and all blah 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 generally correspond with the pricing yield of the S&P 500 index. So the S&P 500 is widely regarded as the best single gauge of large cap US equities. The index includes 500 leading companies and captures approximately 8% coverage of available market capitalization. So it pretty much covers all the main players of the market anyway. So track record, so the Y factor, sorry, I'm looking at a good track record. So this fund was launched in January 1993. SPY was the very first exchange traded fund listed in the United States. With this fund, obviously, as I sort of touched on at the beginning there, it's going to give you diversification, so exposure to 500 of the largest US listed companies across all 11 GICS sectors. As I sort of touched on before too, you're going to get some global leaders, so the big guys, so exposure to some of the world's most respected and successful companies. You touch on some new industries as well, so access industries that are absent or poorly represented in Australia. So, you know, mainly that's why we want these international sort of ETFs or opportunities to get access to the companies that we can't in Australia. So from pharmaceuticals, biotechnology, internet, semiconductors, as well as aerospace and railroads. Obviously, this one you're pretty going to get some really strong index tracking. So a rigorous investment approach that seeks to closely mirror the performance return on the benchmark. So yeah, I think all in all it just gives you a bit of a exposure to that international sector in a broader way. We'll have a bit of a close look at some of the numbers on the next slide. Okay, so the date when I updated this one, we had a net asset value per share of $617.90, tracking just below that at $617.27. Market cap of $83,900,000. Management cost, which is not too bad, I suppose, 0.0945%, higher than some of the other ones, but not the worst you've seen. Yeah, quarterly distribution in February, May, August, and November. When I updated this slide, it was dividend yield of 1.26%. So, as I sort of touched on before, SPY is the oldest ETF in the world. It provides exposure to 500 largest US listed shares. As a low fees and solid execution, this strategy should deliver long-term outperformance for patient investors. The S&P 500 represents one of the most efficient and liquid equity asset classes in the world, by representing about 80% of the total US stock market by capitalization. The index is perceived as more encyclopedic representation of the US equities, comprising all sectors of the economy. So if you're paying a management fee per annum of 0.0945%, that's going to cost you a total of just under $1. So if you invested $1,000, I should say, for that 12-month period, it's going to cost you 94.5 cents for the cost of managing the ETF, which I suppose, you know, not really a large percentage in the overall scheme of things. So alternatives, IVV and VOO. On the ASX is limited direct alternatives to this. There's a combination of different ETFs that focus on different things in the US, but IVV is probably the closest one, and then VOO is the next one. So top 10, you'll be looking at Apple, Microsoft, Amazon, Facebook, Alphabet, Tesla, Nvidia, Berkshire, and JP Morgan. Overall performance, you know, isn't too bad. So since the inception, you're looking at a total return of the fund 10.06%, which isn't too bad. Last year or so, you've had a return of 32.93%, coming off the COVID lows. Sector allocation, information technology, we're looking at almost 28%. Healthcare, 13.5%. Consumer discretionary is 11.82%. Communication services, 11.32%, and financials, which is your banks and all the rest of it, 11.22%. Given it has less than $1 million invested, you know, I think you should probably ask yourself if this ETF is still too small to invest in, and if you should wait and buy it at a later date, or, which I think there's quite possibly better alternatives. So I would go and have a look at IVV. I think that's pretty much got lower costs, and it's a larger market cap as well. So I would look at IVV if you're looking for a recommendation. This one's probably a little bit too small and a little bit too expensive. Are you interested in learning more about personal finance and investing in the markets? If you are, then smash the like here on the left hand side and caress the subscribe button on the right hand side. It's Crack the Sky Value Investing. We'll be giving you up-to-date investing news and content so you can navigate the markets wherever you are. Expand your investment horizon and crack your financial sky. Thanks guys. See you later.